Every society believes money is permanent, that it will always buy food, security, and stability. We treat it as a constant, something that works simply because it exists. But history tells a far more unsettling story. There have been moments when money didn't disappear, wasn't destroyed, and wasn't banned, yet it stopped working. If you genuinely like this type of financial documentaries, must subscribe for more and tell in the comments where you are watching this video now. Let's dive in. In early America, trust in money was fragile from the very beginning. In the late 1700s, paper currency flooded the system faster than real value could support it. Prices rose, confidence weakened, and people began to question whether paper promises were worth anything at all. Merchants responded quietly at first. They raised prices. They demanded payment in silver or goods instead of notes. Money still circulated, but fewer people wanted to hold it. That hesitation was enough to slow trade and fracture the economy. By the 1830s, the problem returned on a larger scale. Banks issued far more notes than they could redeem. Credit expanded rapidly, and growth felt unstoppable. But when confidence cracked, the system froze. Banks failed, businesses closed, and suddenly wages meant little if no one accepted them. The economy didn't collapse because money vanished. It collapsed because belief vanished. Money existed, but trust did not. In 1873, the failure of railroads and banks created a different kind of paralysis. This time, money was still trusted, but credit was not. Banks refused to lend. Businesses couldn't borrow. Projects stopped mid-construction, not from lack of currency, but from lack of movement. Factories slowed. Workers were laid off. Entire industries waited for conditions to improve. Money sat idle while the economy suffocated. The world entered its first global depression not through destruction but through hesitation. By 1929, money was everywhere, but built on debt. Stocks were purchased with borrowed funds, backed by optimism rather than income. Rising prices reinforced confidence, and confidence fueled even more borrowing. When markets fell, money didn't disappear, it became untouchable. People had savings but were afraid to spend. Banks had capital but refused to lend. Businesses delayed investment. Fear locked money in place. The Great Depression wasn't caused by a shortage of currency. It was caused by a collapse in confidence. When trust failed, money lost its ability to move. After World War II, governments promised this would never happen again. Central banks were given new powers, safety nets were built. The idea took hold that policy could always restore confidence. For decades, it seemed to work. Crises came and went, but money kept moving. Then came 2008. Once again, money existed in abundance, but trust vanished overnight. Credit markets froze. Banks stopped lending. Businesses cut back. Governments intervened not because money was gone, but because it had stopped flowing. Afterward, interest rates were pushed lower than ever before. Liquidity became constant. Markets learned that rescue was always nearby. Asset prices surged, even as anxiety lingered beneath the surface. Today, money is digital, fast, and plentiful. Trillions move across markets in seconds. But speed has not eliminated fear. In moments of stress, the same pattern returns. People pause. Spending slows, hiring freezes, lending tightens. Money exists, but movement weakens. This is the most dangerous phase in any economy. Not collapse, hesitation. When enough people decide to wait at the same time, economic activity slows to a crawl. As the world moves deeper into the 2020s, debt levels remain high, growth struggles to keep pace, and confidence depends heavily on policy responses. These conditions do not guarantee failure, but they mirror every moment in history when money stopped doing its job. If history is any guide, the next crisis will not begin with empty vaults or worthless currency. It will begin quietly as people delay decisions and markets lose momentum. Money will still exist, prices will still be quoted, accounts will still show balances. But beneath the surface, belief will weaken, and when belief weakens enough, money stops working. Not because it is gone, but because no one trusts it to move. In the modern economy, money does not move on its own. It moves through systems, interest rates, credit markets, balance sheets, and expectations. These mechanisms determine whether money flows freely or becomes trapped. Interest rates act as the first gate. When rates are low, borrowing feels safe. Debt expands. Asset prices rise. Confidence builds not because incomes grow, but because financing is easy. Money moves quickly, and speed creates the illusion of strength. But when rates rise, even slightly, the system reacts. Debt becomes heavier. Refinancing slows. Investments that once made sense begin to look fragile. Money still exists, but its cost changes how willing people are to use it. Credit is the second gate. Modern economies run on promises, loans, bonds, and future payments, as long as lenders believe borrowers will repay. When doubt appears, lending tightens quietly at first. Banks don't announce fear, they adjust standards, longer approvals, higher requirements, smaller loans. The effect is subtle but powerful. Businesses delay expansion, consumers pull back. Money remains in accounts, but fewer doors are open. Liquidity is the third gate. Central banks can inject liquidity, but liquidity does not guarantee confidence. It only ensures money is available somewhere in the system. Whether it reaches workers, businesses, or markets depends on trust. When fear rises, liquidity pools in the safest places: government bonds, reserves, cash-like assets. Money concentrates instead of circulating. This is how abundance coexists with stagnation. Balance sheets complete the mechanism. Households, companies, and governments all carry obligations. When balance sheets are stretched, every decision becomes defensive. Paying down debt feels safer than spending. Preserving capital feels smarter than investing. This defensive posture spreads. One cautious decision reinforces another. The system slows without a single dramatic event. Modern markets amplify this effect through speed. Algorithms react instantly. Capital shifts faster than sentiment can recover. What once took months now happens in days, yet the core pattern remains unchanged. When confidence weakens, money hesitates. In past centuries, this hesitation was visible in empty shops and closed banks. Today, it appears in frozen hiring plans, delayed projects, and cautious forecasts. The danger is not collapse. The danger is prolonged inertia. When economies stall this way, recovery depends not on printing more money, but on restoring belief. Belief that spending will be rewarded. Belief that investment will be safe. Belief that tomorrow will justify action today. Until that belief returns, modern mechanisms continue to function, but they move nothing forward. Money waits, and when money waits, history suggests the system does too. When the United States slows, the rest of the world rarely escapes untouched. Not because America controls every economy, but because modern systems are tightly connected through trade, finance, and expectations. The dollar sits at the center of this network. It is the primary currency for global trade, debt, and reserves. When conditions tighten in the United States, dollar liquidity tightens everywhere. For emerging economies, this creates immediate pressure. Debts issued in dollars become more expensive to service. Capital flows reverse. Investors pull funds back toward perceived safety. Local currencies weaken, even if domestic conditions remain stable. This is how stress travels without headlines. A rate decision in Washington ripples through markets in Asia, Africa, and Latin America. The mechanism is quiet, but the impact is real. Europe experiences a different transmission. Financial institutions are deeply interconnected with U.S. markets. When risk appetite falls, funding costs rise, credit conditions tighten, growth slows not from local collapse but from global hesitation. Trade amplifies the effect. As American consumers reduce spending, exporters feel the slowdown. Factories adjust production. Shipping volumes decline. Supply chains contract, reinforcing the downturn. Global markets react faster than governments. Capital moves instantly. Equity markets reprice expectations. Currencies adjust before policies respond. By the time leaders speak of stability, money has already repositioned. History shows this pattern clearly. The panics of the 19th century spread across oceans. The Great Depression became global within years. The crisis of 2008 reached nearly every economy within months. Each time the trigger differed. But the transmission was the same. When confidence weakens at the center, the periphery feels it first. When liquidity tightens, weaker systems absorb the shock. Modern globalization accelerates this process. Information spreads instantly. Fear travels faster than facts. Markets react to signals, not outcomes. This creates a feedback loop. Global slowdown reinforces domestic caution. Domestic caution deepens global slowdown. Money pulls inward everywhere at once. No single country causes the stall. The system stalls together. In such moments, coordination becomes critical. Yet coordination is difficult when every nation faces its own pressures. Each acts to protect itself, even if collective action would stabilize the whole. The result is not immediate collapse, but synchronized hesitation. Money still moves across borders. Trades still settle. Accounts still update. But beneath the surface, the world waits. And history suggests that when waiting becomes global, recovery takes longer, not because solutions are unavailable, but because belief is harder to rebuild at scale.